Well, folks, we have some concerning news if you're an Apple shareholder. There's some really bad news that Apple's Mac shipments have fallen more than 40%, worse than major rivals. Now, just on the surface, this doesn't look good. When a company has any major product, like Apple with their Mac, which is a major product line, and it's fallen off a cliff, it's down over 40%, that's not a good thing. But I am a big shareholder of Apple. I've been a shareholder of Apple for many years. I've studied this company in depth. And I'm going to tell you in this episode why I don't believe you should be concerned about this, why I'm not personally concerned about this. We're going to be going over some data that shows how this fits into the grand scheme of things with Apple. So we're going to be looking at some charts and data of why I don't believe investors should be concerned and really what the main focus here is for Apple. Now, there is some other news that I think is concerning for big tech in general, and that is that many of the employees seemingly, and we know this has been an issue in the past of having too many employees, but seemingly the problem is much worse than we first feared. Many employees at big tech are literally doing nothing. That's right, they're just sitting around. And we know this because at least one of the former employees at Meta, this woman, said as much. She said that she didn't do anything for 6 months. So we're going to be looking at her interview and trying to dissect that problem. And then finally, we have some exciting news that Warren Buffett is buying Japanese trading houses. That's right. I wasn't that familiar with what these companies are, but Warren Buffett's going big into them. He's upping his stake in all of them, and we're going to look at what these companies actually do and why Warren Buffett's buying them. So we have a lot to get to in this episode. Let's go ahead and jump right in. Before we even get to the topic on hand, I just want to take a second and thank everyone that's subscribed to the channel, that's followed along. I appreciate your support. And we've almost hit 80,000 subscribers for this channel. We're going to relatively soon, which is just incredible. This is a pretty new channel, so hitting 80,000 subscribers is phenomenal. So I appreciate everybody that does that, everybody that likes the videos. Now, there's two companies that have really driven the returns for the NASDAQ this year. If you haven't been following along, we can look at the NASDAQ's returns this year, and we can go year to date, and this is what it looks like. We're at the QQQ, so it's up 19.52% year to date. Big returns this year for the QQQ. The S&P 500 is doing well, but not nearly that well. Now, there's two companies in particular that have really boosted the returns of the NASDAQ. They've kind of been pushing up the entire index with a bunch of other slackers that are following along. Those two powerhouse companies are Apple, being one of them. Apple, in particular, has pushed the NASDAQ up a lot because Apple has a huge weighting. It's a massive, massive stock in the NASDAQ. And the fact that it's up 29% year to date is a big part of the QQQ's returns this year. So Apple in and of itself has really pushed up the whole index, up 29%. It's on a very good run. It's trading at 161. And then we have the other one here, Microsoft. This is the other one that's really helped the returns of the QQQ. It's up 18%. If Apple and Microsoft have not done this well, then the QQQ in and of itself would not be doing this well. It'd be probably doing about half the performance. So these two companies really are huge weighted in the QQQ. They've pushed the entire index up. They've outperformed the broader market to a huge extent this year. Now, while these companies have performed so well, Apple's up 30% year to date. It's pushing the NASDAQ up. We have this new news coming out that's objectively not good. This is glaringly bad news that Apple's Mac shipments, one of their main products, is down 40%. That's from the IDC, and it's the manufacturing data. Now, we even have some graphs to show how bad this is. This is the PC market decline in 2023. So there we have the big players, Lenovo, HP, Dell, Asus, and then we have Apple, which is the biggest outlier. It's fallen for Apple more than any other company. So a lot of investors are asking, why is Apple doing so well this year? Why is the stock price up 30% when we have all of this bad news coming out? And I think that's a very fair question. Now, I just want to set some background here on something that I think is important. I own Apple. I own a lot of this stock right now. It's a pretty big position in my portfolio. I currently have a holding value of $46,681. And the gains of this company have been phenomenal. It's been one of my best performers ever. The gains are $17,535 on this one company. I first bought Apple back in 2017 on a split adjusted basis. That was $43 per share. So Apple right now, we can look at the share price. It's trading at around 160 right now, 161. I was buying the company back in 2017 at $43 a share. Now, at the time, I was buying it with smaller quantities of money, so only a couple $100s at a time, but I added to this position. I added to the position. When it dipped, I would add more to the position because I thought that Warren Buffett was right. I thought that the company was way undervalued. I thought that investors had this one wrong. And I was buying the company all the way from 2018, 2019. I bought more of it in 2020, another $20,000 of it in 2020, and I've just held on to the company without selling any of it. When I look at the gains that I have from this company, I think it's from buying into a great company at an undervalued price and holding. And when I think back over the most difficult parts of holding this company, of not selling out of it, the most difficult challenge of getting these type of gains in Apple has been not to sell when I get news like this. Not selling out, not getting scared out of the position. That has been the biggest thing that I've done, the biggest accomplishment in holding Apple. That is the reason that I have $17,500 in gains. Because over the past 4 years, over the past 5 years, back in 2017, there have been dozens and dozens of reasons to sell. There's been news like this that have dropped every single year without a doubt. Some type of product of Apple is not doing as good as expected. There's some big concern in the PC market. There's always something to be concerned about with any company, but especially a very public one like Apple. And had I sold out at many of the other type of glaring red news or different challenges that Apple faced in the past, I wouldn't have the gains I have today in the company. This is the challenge with holding stocks, with holding individual companies. The biggest challenge is not getting scared out of good positions. So with Apple, I attribute nearly 100% of my success in that position in particular to not getting scared out of it. And believe me, there's many people that try to scare you out of position. I've had people argue in the comments of YouTube videos about how I'm an idiot and I'm a bubble investor buying Apple at top valuations way back in 2020 and 2019. Many people saying that I should sell the company, and I've held on to it, and it's been a good investment that's grown its intrinsic value every single year. So that's just some foundation. Before we even dive into this news, that's the framework that I look at this news. For me to sell out of a major position like Apple, a high quality company, I need to have an incredibly, shockingly good reason. I need to have material evidence that my company's intrinsic value is going way down, that the thesis is no longer in existence. I need evidence that the mode of the company is completely gone. So having said that, let's go ahead and look at this news in particular. Apple Mac shipments fell 40.5% in the first quarter of 2023. There's no way to sugarcoat it. That is a dramatic fall. Anytime a line of revenue or a product from a business falls 40.5%, that is a notable, massive fall in price compared with the same time prior year. So this is a year-over-year comparison. Now, my first thought here is that this is why I don't buy hardware makers specifically. I don't buy companies that are just hardware makers. Now, Apple sells a lot of hardware, so I'm violating one of my rules there. Apple is a hardware maker. But this is the problem with hardware makers in general. The amount of sales they have is very unreliable. It's very unpredictable. It's very volatile. So in this case, it's fallen 40.5%. This is from the broader contraction in consumer demand, according to research from the IDC. So last year we had low unemployment. We had tech workers that were still gainfully employed. Everybody had jobs. Demand was high for PCs. Lots of companies at the time were expanding their payroll. They're expanding the amount of seats in their workplace. Now they're all cutting back. We know that Amazon's cutting seats. We know that Microsoft's cutting back. Apple's trying to get people back into the office, and they're kind of doing layoffs as well. Meta's doing massive layoffs. So the tech market in general, which is led by big tech, is cutting back a lot. And of course, that's going to cut back on PC sales. So MacBooks in particular, which grow in sales when all these companies grow in seats and in an amount of employees that need them, of course, it's going to have the reverse when they cut back. And we're seeing that right now. So there's a scary news. Now I want to go over why I would never sell Apple because of this news alone. Let me go ahead and show you a little sneak peek of Qualtrim 2.0 and one of the charts here. I just want to use this one singular chart, which is the revenue chart. So right here we have Apple's quarterly revenue. The company, it makes a lot of money. They pull in a lot of revenue. Every quarter, we're looking at numbers that are in the literal 100 billion plus. So tons of revenue from this company. Lots of revenue. Now, a new type of thing we're introducing to Qualtrim, and this is not released yet, so this is going to be in the future version, probably in a couple weeks. But this is a new thing where we can segment this by product. On some companies, they break down their revenue into different product categories based on their filings. So we have it right here. This is exactly the same. So the bars haven't moved. It's the exact same, but now we're just drawing lines on them to see where the revenue is coming from. Now, we can focus in on a couple things here. If I just go, for example, I cross out everything else and I isolate out just the Mac. This is the revenue that's dropped 40%. So we have right here the Mac revenue, which is only $7, $8 billion, $9 billion, $10 billion. And it looks like this next quarter, it's going to go down to maybe $5 or $4 billion. So to put that in perspective, the revenue might drop to like right around there next quarter. That's what we're looking at. Revenue right there. A big drop. Don't get me wrong. That doesn't look pretty, having the revenue go down like that below where it has historically been. But that's kind of the worst case scenario. For one quarter, the revenue of this one business line drops by 40%. We look at this overall, and I want you to notice something here. The revenue of the Mac has not really grown all that much over time. It's pretty flattish. If I was buying Apple and all they sold was their Mac, and this was their only form of revenue, was just selling Macs and selling Macs, and their revenue looked like this, I would never be interested in this company. Not enough growth. They're just not growing the top line enough. Since 2019, they were doing $6 billion in revenue from the Mac. They've upped that to $8 billion since 2019. And it's still a little unpredictable. It's not the most smooth revenue quarter over quarter. Now, if we look at the same thing, we can look at some other revenue lines here. We have the wearables. This is actually a product category that I'm very excited about with Apple. I think the Apple Watch is a genuine health device. And I think that if they get glucose monitoring, I think that'll be an absolute game changer for the company. But regardless, right now, the Apple Watch is the best tech watch in the industry by far. No one else even comes to a close second. And this has grown over time, I think, at a little bit faster of a pace. So we have right here $6 billion in revenue per quarter, and that's going up to around levels of above $12 billion. So at this last quarter. But on average, I'd say it's gone up from $6 billion to around $10 billion. So very good growth in their wearables category. I like seeing that from Apple. If we just focus in on the iPad category, pretty similar to the Mac, but not quite the same. I think the iPad is used more for residential use, people just using it in their homes. I think there's some business applications for it, but I think the Mac is far more business oriented. The iPad is more kind of consumer discretionary residential use. We have this product line going from around $5 billion per quarter to around $7 billion, $7.5 billion based on last quarter. So some growth as well, but not significant growth. These are growth levels of maybe 20% over the past couple of years. Then we have the iPhone category. The iPhone category is the primary product. You can see the numbers here are much bigger. These are 55 billion, 65 billion, 71 billion, 65 billion. And it looks like it's growing, but again, not super fast. We have around $30 billion in revenue, and then we have $40 billion, and then maybe $50 billion here. So they've gone from $30 to $50 billion. Pretty good, but it's still a little shaky. Not the most reliable revenue. We can see that the iPhone actually sold less from 2022 to 2021. So it actually declined in revenue. So far we've looked over all the hardware from Apple. The hardware with the MacBook, the hardware with the wearables and home accessories, the iPad, and the iPhone. That is the revenue of these different hardware devices. And overall, they're growing. But again, in aggregate, they're growing at a reasonable but kind of slow pace. If I was just looking at this, I think that Apple's not really growing all that much. Going from 45 billion to 65 billion over the course of 3 years, it's decent. I'm not saying this is terrible, but it's not the fastest growth ever. Now, there's one form of revenue that we've forgotten here, and it is the most important form of revenue for Apple, which is the services. The services include their insurance business, which is Apple Care. The services include the Apple Music subscription. It includes Apple Fitness, Apple TV Plus. It includes the App Store, all the business that they extract economic value out of with the App Store, and the 30% fee, the 15% fee, that is the service business. I believe the reason that Warren Buffett invested in Apple is largely because of that App Store. Apple has made a huge moat, and then they own a toll booth where everybody pays their little fee as they cross across that very busy bridge. So we have the service business here. Now, the service business is growing very steadily. And notice that it's far more consistent quarter over quarter. This isn't annual growth, this is quarterly growth. Back in 2019, it was doing $11 billion. And then the most recent quarter, it did $20.77 billion. So it's doubled since 2019. It's not gone up 20% or 50%. It has gone up 100% since 2019. And it's far, far more predictable. Incredible growth from the service business. It is now a $20+ billion quarterly business. Just incredible to see the growth of this. Why is this business more important than the other businesses of Apple? Well, we can look at that. Let me go back to traditional Qualtrim here. Let's go ahead and take a look at the overall margins of Apple. We can go to the ratios. We can look at the gross margins of the company. Apple likes to keep their margins around 40%, maybe a little bit higher if they can squeak out higher margins. So that's been the margins overall, around 40% there. Last year, their margins were 43%. That's for the overall company. The nice thing about the service business, this line of revenue right here, and the reason it's so important is Apple's service business has margins that are 62.8%. So their service business has margins that are 50% higher than the rest of the company. That is a big step up in margins. So not only is the service business growing faster than every other component of their revenue, but it's also a more reliable form of revenue, less volatile than their iPhone revenue that goes up and down quarter over quarter. The service business is more reliable, it's growing faster, and it's much higher margin, 50% higher margins than the rest of their business. This form of revenue is crucial. This is what Apple needs to focus on growing. Whether or not the Mac has a bad quarter and it's down 50%, who cares? The Mac's a great product. Everybody knows it's a great product. It's beating the benchmarks of all the other laptops. It has a faster chip than Intel. It's doing better than any other laptop. I'm not concerned about this cyclicality in one portion of their hardware business. I'm focused on the intrinsic value of the overall company, which is growing. And the service component of that intrinsic value is a major factor. So when I look at this news, this type of shocking headline news, I think this will shake out investors that don't really have a strong thesis on Apple. They haven't studied the company that much. They're not really aware of what they're actually investing in. But I think anybody that actually looks at Apple holistically and looks at the business knows that this is not a long-term concern. Furthermore, I have some analysis here from Morgan Stanley that goes over some company data with Apple with their estimates of the amount of subscribers Apple has with their various subscriptions. This is the Apple Fitness, the Apple TV Plus, all those type of subscriptions. They're up to numbers that are mid 800 million. They estimate June of 2022 that it's 860 million. And again, that's a little bit back, June of 2022. It could be closer to 1 billion subscribers by now. We don't know, and we don't know if these numbers are entirely accurate. These are estimates, but I'm more inclined to believe them. Apple has a variety of services that have been so far, I think, a huge success, and they're continually entangling themselves in the lives of consumers more and more. So no, I'm not selling my Apple shares. This doesn't cause me any grief or any concern. As of right now, I think that Apple's still decent value. I think the company's actually decent value, even with the run up. And I know some people will say, Joseph is just pumping Apple, trying to boost the stock, which is just ridiculous. I could never move the price of a company that's at a $2.6 trillion market cap. So I don't need to boost Apple's stock price. They're going to do that on their own. The company's going to do that by generating more and more free cash flow. Now, moving on, I want to talk about this story here, which is an interview from an ex-Meta employee. So this lady was a recruiter at Meta, and she was hired. She worked at the company 6 months, but saying she worked at the company is a little misleading because work entails that you do something, that you're productive, that you contribute, that you're paid in exchange for goods or services that you can provide back to the company. What she did was not work. She was paid $100,000 or whatever her salary was to do nothing. So let's go ahead and hear her story.
Yeah, I definitely feel like I got hoodwinked, and $100,000 sounds like a lot of money,
Not in
but
San Francisco.
when you're laid off, not in San Francisco, and when you're laid off 6 months into that, and you made 75,000 the year before, it's starting to look like a pay cut now.
She's right. So a lot of people say that she's lucky. She got to sit around for 6 months and get, $100,000 salary, but she left a job that was paying her $70,000 per year to join Meta. They hired her on for a pay bump. She worked for 6 months and now she's fired and she doesn't have a job. And I certainly agree with her. If this were me, I'd rather have just kept my job at $70,000 a year and not worried about the hassle of working at Meta. And by the way, it's not good to just do nothing at a job. It's not fulfilling. It makes it so that you get further and further behind in your career. You're not developing skills. So it's not like a big win if you sit around and do nothing at your job.
Yeah, so I was actually a part of a program, and it doesn't mean much if you only have 6 months of experience, which is the exact reason that myself and other colleagues were so upset. If you're hired into a program and they say that it's going to be 1 year, they tell you that they have even budgeted for this program for the year, and that you're being told every single week, up until the week before layoffs, that your position is not going to be eliminated. It starts to look like something is up. You definitely feel that there is something going on here.
She doesn't say it, but she basically is laying out that the company, they lied to her. They were completely dishonest. They told her that they had this program, that they had a budget set for it, that her job was okay. Even leading up to the layoffs, they said for week after week after week that you're not part of this. You're not going to be laid off, which goes back to a point that I've made repeatedly. I've made this point on Twitter many times. I've made it on YouTube videos. Don't ever treat your job like it's entirely safe. Don't ever treat job security that way. All it takes is one decision from one person that's one step ahead of you, one step above you, to decide one decision and then you're gone. And it doesn't matter anything that they've said previously. It doesn't matter all the promises that are made. So don't get it in your head that you have job security. There's no such thing as job security. The financial security you can have in your life is by having transferable skills, having a good network, and having at least 6 months of saving. That is the security you can have. Because many of these companies and the way that they treat their employees is wildly deceptive, wildly dishonest. They'll say one thing and do the next, and I don't think they should be trusted.
So I don't know as far as other companies, but I know that Meta's reputation is really going to suffer from this. Not only did they tell a bunch of people back in November that if they were not laid off, that they would be safe. Now we're saying that that's not true. There's a lot of people that are coming to find out that, hey, maybe my position isn't safe. And that's just causing a lot of instability with the company. I think that the way that they did these layoffs, it definitely could have been done. It could have been better. There was a lot of miscommunication, a lot of confusion. And then after Google announced their severance package, there's been a lot of people that reached out to me that say that they're not happy with what Meta's offered.
So she says that Meta's reputation is going to take a hit as well, which I agree with. These companies, Google and Meta, hired so many employees so fast, and I was calling it out before they ever announced layoffs. I was calling it out in their earnings report. Why did Google hire an additional 30,000 people in a 9-month period? 30,000 people added to the payroll. Why did they hire so many people 6 months before doing layoffs? That is just mismanagement, poor management by these companies, which really affects real people's lives, affects the overall industry, affects everybody involved in it. And it also impacts the reputation of these companies. Google and Meta are going to have a more negative impact in the industry because of their hiring and firing practices. And they can't get rid of it by tacking on big severance packages. That's not enough to fix this. Out of these companies, I think the one that looks the best in this situation, I think again, is Apple. I think that they were the most disciplined with not over hiring. If you look at the amount of payroll increase quarter over quarter, it was much slower than Google or Meta. And Apple's been the only company so far that I think has avoided wide-scale layoffs. So I think that so far they look the best. But right now, I think that Netflix is struggling with morale, Meta struggling with morale, I think Amazon is, and I think Google is. I think all of these companies have a lot of internal problems that are going to have to work themselves out over the next couple of years. Now, moving on, we have some big news coming from Warren Buffett. He said that he's purchasing more of these Japanese trading houses. Berkshire Hathaway has raised its stake in all 5 trading houses to 7.4%. So he's buying more of them. Now, you can name off the companies here. I'll butcher the names of them. They're all in Japanese. We have Mitsubishi Corp. We have Mitsu and Company, Itachi Corp, Marubeni Corp, and then Sumitomo Corp. Something like that. These companies are trading houses in Japan. Now, I have to admit, I wasn't too familiar with what trading houses are. I went and read about them in the Wikipedia entry. And basically, they trade all sorts of commodities. They're like an interchange for trading these type of products. It has a small description here. It says that Japan's 5 largest trading companies, known as Sogu Shosha, are conglomerates that import everything from energy and metals to food and textiles into resource-scarce Japan. So they're basically this intermediary that trades all of these different products into Japan, and they seem like they are at an intersection of transaction with something that is very necessary, that Japan has to have. Like it says here, Japan has natural resource limits by the country, and so they have to import this stuff. They have no choice. And that right there is a nearly perfect description of the type of investments that Warren Buffett looks for, specifically toll booth investments. They're also a bit monopolistic. Now, Buffett doesn't like to use the term monopolistic because if he started to say, I just invest in monopolies, companies that really have limited competition and they can charge a fee based off of a lot of traffic, that wouldn't look good. Warren Buffett's very good at public relations. So he doesn't say that he's investing in monopolies. In reality, all of his investments are basically monopolies to one extent or another. Let me go ahead and look at his US investments here. We have this on Datorama, and we'll look at the similarities here. Again, he's investing in these Japanese trading houses, which are at the intersection of all of this unique stuff that Japan needs, all of these resources they need, and they make money based off of trading these in and out. Now, we have Apple here. Apple is a toll booth investment. Now we have Coca-Cola. Coca-Cola is somewhat of a monopolistic business. They have huge distribution network. They have a basically an insulated position into a lot of different markets, and they charge a fee based off of their name. That's what they're really selling, is their name. All Coca-Cola really is just sugar and water. What they're selling is the name. We have Moody's Corporation, which is, of course, a monopolistic toll booth company that shares their monopoly with S&P Global. VeriSign, this is another toll booth company. We have Visa, that's another toll booth company. We have MasterCard, that's another toll booth company. On and on and on. Around 1 out of every 4 companies that Warren Buffett invests in are toll booth companies. Now, Warren Buffett does have a number of other holdings that aren't toll booth companies, specifically in energy and finance, but for most of his normal companies that he chooses to invest in, that Berkshire invests in, they are monopolistic toll booth companies, which I believe fits the description of these Japanese trading houses. With what I've read about them, they seem to fit right in with the Buffett portfolio. So that's not a shock to me. I think he's going to buy more of these companies anytime the price goes down, anytime he thinks the value is attractive. But that's all for now. I hope you enjoyed the show. If you want more content, head over to the Patreon. We have more episodes there, as well as you get access to Qualtrim.com, which is the research tool that I use. Other than that, I'll see you in the next one.